Welcome back, everyone. I hope you've all been well. Today's video is inspired by today's Fed press conference, and while I wouldn't say that there was any terrible surprises or immediate causes for massive concern, there were a few things that I would call kind of a step in an uncomfortable direction. So I'm going to discuss what gave me and seemingly the market pause. Now, up until today, while I wasn't always fully backing all of the Fed's policy decisions, I would say that there was a certain aspect of their stance that I was proud of. They were not going to, they didn't seem like they were going to allow the market to the running narrative of the market to control them. I thought that they would be acting more rationally. I thought they would not be panicking, not be rushing. And this kind of gave the allure of, they have a good idea of what's going on and they would look at the data. Kind of like if you're on a plane and you're more comfortable when the pilot is someone who's been flying for, I don't know, 25 years and they know what they're doing. So it's a comforting, if you're going through turbulence and you're like, okay, no, the pilot knows what's going on and it'll be okay. But today, when listening to the press conference, the impression that I got was not that. The two areas that I found most concerning were, one, they seem to be moving towards they'll do whatever is necessary, not what's necessary. Now, this isn't necessarily exactly what they said, but just kind of a slight shift in the way of, well, they're ready to do more and more. And this is concerning in terms of that, they seemed measured, but at the same time, they're kind of moving towards nothing is off the table. They're not limited, saying things like, and perhaps faster, the risk is to the upside. All those kind of hints of, okay, we're ready to be told to do more. And the other piece of this was that they were saying that they will, they'll listen to the market. And now, this isn't necessarily a bad thing, but I'll get to more why this is a problem. But, people say, or the Fed likes to say, that they're data-driven. But here, it seemed like they were more market-driven than data-driven, and there's a difference. And the problem being that while data is truth in its own form, or however it's measured, the market is an emotional child, and it gets caught up in every passing narrative, and the wrong narrative at the wrong time can cause some issues. And while I'm sure there are people who will say the bond market isn't, but the thing is, the bond market isn't blind either. The bond market will take cues from other markets, and that's kind of how you look at the best macro, who's the best macro trader in history, and why is it Stan Druckenmiller? And then you look at what people like that will say, and they look at kind of the internals of the market and kind of read that to tell them what's going on. So, when you have things like what happened this year, you have tech falling either because of slowing growth, tough comps, retail turning on it, or whatever you want to say is happening. And then you have the other equity professionals who look at this, and here's my best impression. They'll say something like, or think something like, well, I'm smart, so I know why this is happening. This is happening because of people think the Fed is going to raise rates, because that would take down the valuation in tech. And so from there, what you have is these people start positioning and start telling that narrative because they're reading the market and seeing, okay, that's kind of what I kind of thought was going to happen because there's inflation and stuff, so this makes sense. And then they start positioning in a way that for that type of market. And then all of a sudden, you have them and the next level up, which is the people predicting the bond market, and they start thinking, oh no, oh boy, there's a lot of rate hikes incoming. And so you just get this loop that sets up for people who are naturally worried about inflation and smart enough to read the market signals, and then they see, oh my gosh, there's rate hikes coming. And the other thing is, even if you think that, the market is rational in terms of setting expectations for stuff like this, the market, they price in what they think is going to happen, not what should happen. And so from that perspective, you kind of take a few steps and you're like, okay, so the Fed is this entity with thousands of supposedly really smart people, really smart, really educated, but none of them are thinking. And then you have, the smart people that tell them what you think are going to happen, and they're not advising them. They're betting on what will happen based on what the narrative chasing fast money will do. And so while this isn't the only thing that is driving policy and driving markets, you have a second, arguably far less competent person whose hands are also on the wheel. At the same time, it kind of gives a sinking feeling that they will do exactly what the market is concerned they will do. Because if the market is, oh no, they're going to hike too many times and send them to recession, well, that's kind of what they're going to do, because they're going to listen to the market. And the market, it makes it on both sides easier. No one takes responsibility. The Fed, you don't want to be in charge of sending a major market into a recession. But if the market says that we're going to do this, we're just listening to the market. And the market is like, oh crap, the Fed's going to mess up. And there you have it. That's kind of nobody's really thinking. And then add to that all of the price-driven narrative that we're hearing these days of the Fed's behind the curve. The Fed's behind the curve. The Fed, they're behind the curve, which means they're going to hike rates soon and be more aggressive, and that's going to cause even more damage. And this whole thing is a self-reinforcing narrative that has no basis in what should happen or needs to happen, just what the market thinks will happen based on where prices are moving. Now look, there are breaks to this type of thing, and the self-reinforcing aspect of the market does have its limits. Sometimes that'll look like a Fed put, in terms of part of the market will go and start breaking itself, and then it'll be like, oh my gosh, the Fed's going to do too much and have damage, and then start kind of, once it's obvious, the Fed could shift and it'll be like, oh, the Fed's chickening out. And also, what's very important is that the market environments change over time. So if we're panicked about the Fed doing too much now, and then people kind of get tired of that, or sell out, and then we rally, then kind of the narrative can change by itself to, oh no, actually, inflation's receding, everything's good, we're strong, whatever. So no, this is not a be very concerned now, oh my God, there's no one on the wheel, we're going to crash. Not at all. It's saying, while I was very comfortable that the pilot with lots of experience was flying this plane, now he's out here and some teenager walked into the cockpit, and it's been a while. Pilot's still out here kind of trying to figure out how everyone's doing, and I'm not really sure who's flying this thing. And that's making me uncomfortable. And so that's making the pilot kind of be out here, oh, are you all right? Why are you uncomfortable? When really you'd like the pilot to just be back in the cockpit, and then everyone would be comfortable. Now look, that was the disconcerting part of today, but it wasn't all negative. They didn't raise rates today, which in my opinion would have been a big mistake. And this gives us some months some time to figure it out and for the market to move past this Fed fear-driven panic, reflexivity. The sell-off is like, oh, the Fed's going to ruin things. Now, the bond market never priced that in for today because that would have been too big of a shift. But back to the not positive, they did kind of get significantly more hawkish, again, in response to kind of what the market is saying. But once we move past this panic, hopefully we can do that in some months. And because we didn't panic today, I don't think we'll get much damage before what happens. What I believe happens is that things begin correcting themselves. If we get one hike in March, maybe, and then into April, May, we start seeing inflation decline, which I think is quite likely. Hopefully the market sees that as, okay, this is working. It's not a problem. They're not going to panic, and not, oh my God, they did too much. They're hiking into a recession, because again, that could kind of self-reinforce itself in different ways. But in the end, it's not a huge, terrible, or unexpected move today. It just gave some undertones that were uncomfortable or perhaps disappointing. So in conclusion, today's press conference did not inspire the level of confidence that I had hoped it would. They didn't break anything, and they won't break the market voluntarily, but they will allow the market to break itself if that's what it so chooses. I think we still have 4 to 6 months of real data before we get any answers. So in the end, this wasn't a meeting as big as March, and even in March, I don't think 1 or 2 hikes this year would cause much damage. The question would be, if it becomes a 50 basis point hike in March, that would be a mistake, in my opinion. But you're going to have people kind of talking about that, and you'll have the behind the curve narrative continue for a few months. On my part, what I got the most wrong about this meeting was I didn't expect this level of flexibility from the Fed. And frankly, I think it's more likely to be a mistake than not. But again, this is something we'll probably only know in Q3 or Q4. And that's really all I had to say about today's meeting and news. So with that, I will wish everyone the best, and until next time, have a great day.